Hello everyone, you are watching Saheb Academy. If you like our videos, then please subscribe to our channel and also hit the bell icon for the regular updates, and also follow us on Instagram, Saheb Academy. Now let's go to the video. Hi everyone, this is the second video of internal reconstruction chapter, and in the previous video, the first video, we saw the concept of internal reconstruction, and with the help of an example we completely try to understand the concept of internal reconstruction. Now if you haven't watched that video, then please go watch that video first. Alright, I will put the link in the description. Now in this video we are going to see the accounting treatment that is required under internal reconstruction. Okay, we'll see the accounting treatment. Now here in this chapter there are only journal entries. Okay, some journal entries are there, very less journal entries. All right, 6 to 7 journal entries depending upon the questions, and then we need to prepare the balance sheet. Okay, and we'll also see the methods. Okay, the method, different types of methods that company take to do internal reconstruction. And there are a lot of methods: alteration of share capital, reduction of share capital. We'll see that. Okay, now don't mistake that these methods are like accounting methods. No, these are not accounting methods. These are the internal reconstruction method. To do internal reconstruction there are lots of methods. All right, there's only one method here: to do some journal entries and to create a balance sheet. That's all, nothing else is there. Okay, these are different methods to do internal reconstruction. All right, for companies. Okay, now let's see that. Now let's see the methods of internal reconstruction. Now these are the different types of methods that a company can go for to do internal reconstruction of their company. Okay, now what do you mean by internal reconstruction? Let's recall that. Internal reconstruction means to reorganize the company, to rearrange the company's structure, the financial structure, so that the company can become a profit-making company. Now it's suffering losses. That's why it's going for internal reconstruction, right? It's suffering losses upon losses, so that those losses can be written off and it can become a profit-making company. All right, that's the basic objective and idea of internal reconstruction. Now these are different types of methods that a company can go for. All right, these are the different ways. These are not accounting methods. Okay, there is only one method here. You have to prepare some journal entries and then you have to prepare the balance sheet of the company. All right, only one method, but these are the different ways of internal reconstruction. But in the books it is said method, so we are writing here method, but these are actually ways that the company can go for to do internal reconstruction. Okay, so don't think that this is very tough chapter because there are lots of methods over here. No, these are not like that methods. Okay, so now let's see these ways. See, the first method is alteration of share capital. Now what do you mean by alteration of share capital? Alteration of share capital means changing the share capital. Now how can you change the share capital? See, there are 3 different ways here. Okay, 3 different subways. See, first is subdivision of shares. Now what do you mean by subdivision of shares? Subdivision of shares means splitting the shares. Let's say if you have one chocolate and you have 4 or 5 brothers and sisters, then you can split that chocolate into many pieces so that you can give it to your brothers and sisters, right? That is what is meant by subdivision of shares. All right, one share of 100 rupees each can be divided into 10 shares of 10 rupees each. All right, from 1 share to 10 shares. That is what is meant by subdivision of shares. Okay, then we have here consolidation of shares. Now what do you mean by consolidation of shares? Consolidation of shares is exactly opposite to subdivision of shares. Okay, here you will group the shares together. Here you will bring the shares together, you will combine the shares. Okay, let's say 10 shares will be combined into 1 share. That is what is basically meant by consolidation of shares. And then next we have here conversion of shares to stock and vice versa. Now what is meant by share? Share is a single unit of capital, right? Shares. And stock is a collection of shares, so it can be converted to stock and stock can be converted into shares. That is what is meant by conversion of shares to stock. All right, and here only the face values will be changing. Okay, and the number of shares, the amount will remain the same. Now let's go ahead. Then next we have here variation of shareholders' rights. Now what do you mean by variation? Variation simply means change, right? Change in something. So change of shareholders' rights, that's what it means. Okay, so shareholders, now shareholders have different types of rights. Okay, so they may have a right to dividend, they have voting rights, and they have different classes of shares. So all these rights they have. So these rights can be changed by the company by negotiating with the shareholders. Okay, mostly in internal reconstruction what happens is the preference shareholders, they have rate of dividend, right? Fixed rate of dividend. So that fixed rate of dividend can be changed. Okay, now the company is making losses, so they may reduce that rate of dividend, all right, by negotiating with the preference shareholders. From, let's say, if the company is paying dividend of 13%, then that 13% rate they can change it back to, let's say, 9% or 10%. Okay, they can do that. And then type of shares can also be changed. Now with the example of preference shareholders only, I will explain this to you. See, preference shareholders, in preference shares there are two types of preference shares: cumulative preference shares and non-cumulative preference shares. Okay, in cumulative preference shares what happens is, if the dividend is not paid in the first year, then the first year, second year, third year, all the dividend will get accumulated. If they are not paid, then all the outstanding dividends will get accumulated. Okay, and then you will have to pay, the company will have to pay all of them together in the fourth or fifth year whenever they declare the dividend. Okay, that's the problem of cumulative preference shares, they get accumulated. Okay, let's say first year 10,000, second year 10,000, just for an example, and in the third year also 10,000, and in the fourth year they will have to pay the fourth year dividend and all the previous year's dividend. Okay, so that's a problem of cumulative preference shares. So the loss making company cannot do that, so they will convert it into non-cumulative preference shares. Okay, so the type of shares can be changed. Then next here we have reduction in share capital. Now what do you mean by reduction in share capital? Reduction in share capital means reducing the share capital. Okay, reducing the share capital, and it can be done by two ways. Okay, first way is reducing only paid up value. Okay, and the second way is reducing both face and paid up value. Now you need to understand what is meant by face value. See, face value means the value of the share. Let's say 10 rupees, a share has 10 rupees value. Now it is similar to a 10 rupees note. How 10 rupees note has 10 rupees value? Similarly, a 10 rupees share will have 10 rupees face value. Okay, it is called face value of a note, face value of a share. Alright, and what is meant by paid up value? Paid up value means how much is paid against that share. How much is paid against that share? Let's say you bought a share of a company, and you paid the application money. You paid what? You paid the application money 5 rupees, and then you also paid the allotment money 2 rupees. Now how much it is? 7 rupees, right? So the paid up value of that share which you bought is 7 rupees, because it is 7 paid, right? 7 rupees is paid against it, so the paid up value of that share is 7 rupees. Okay, that is the difference between the face value and the paid up value. Now the share which you bought, it has face value of 10 rupees, but you paid only 7 rupees, so the paid up value of that share is 7 rupees. Okay, that is the difference between the paid up value and the face value. Now to understand this concept further, reduction in paid up value and reduction in face value, let's see this example. Let's say there are 10,000 shares of 10 rupees each. Okay, 10,000 shares of 10 rupees each. 10 rupees each means it has the face value of 10 rupees, and the capital, total capital is 1 lakh. Okay, 1 lakh. Now the company wants to reduce the capital. Okay, internal reconstruction scheme, they want to reduce the capital from 1 lakh to 80,000. So what they did was number of shares is same. Okay, 10,000 shares of 10 each, so the face value is also same. Face value is also same, but they reduced the paid up value. Before it was fully paid up, the shareholders had paid everything, whatever liability they had on those shares, they paid them, right? All the 10 rupees the shareholders paid before, but the company negotiated with the shareholders and said our company is about to die, so to save the company, please sacrifice your share, sacrifice your claim, sacrifice your amount. So from fully paid up, it reduced the paid up value to 8 paid up. 8 paid up. That means 8 paid up means the shareholders lost their 2 rupees. Okay, and then in the future again they will have to pay 2 rupees. Again they will have to pay 2 rupees, because 2 rupees are pending now. The face value is 10, but it has been decreased to 8. The fully paid up value has been decreased to 8. That means 2 is still pending, and they will have to pay that in future. Okay, that's the thing. Here there is double loss to the equity shareholder, but it is done by the company so that the company can be saved. Alright, this is what is meant by reducing the paid up value, okay, from fully paid up to 8 paid up, 7 paid up, 9 paid up, anything they can do, okay, by negotiating with the shareholders. And now let's see the face value. See, reducing the face value and paid up value means, let's say there are 10,000 shares of 10 each, fully paid, and 10 each means face value is 10, 1 lakh capital. Now it reduced it to 80,000. Now by reducing the face value, see, 10,000 shares, number of shares is same of 8 rupees each. Before it was like 10 rupees each, 10 rupees each. Face value was constant, it was not changed. But here the face value has been changed from 10 to 8. That means 2 rupees of the equity shareholders or preference shareholders has been lost. Okay, 2 rupees has been lost, but they won't have to pay any amount in future because the face value has been changed. Face value has been changed, so no outstanding amount of money is there. Okay, so no outstanding, only the face value has been changed. So automatically paid up value also decreased and they lost 2 rupees. Okay, so from 1 lakh it became 80,000. That is what is meant by reducing the face value. Okay, so here only single loss, and there by reducing only paid up value they have double loss. Okay, this is the difference between the reducing only paid up value and reducing both face value and paid up value. All right, and then next we have here compromise or arrangement. Now what is compromise or arrangement? Compromise or arrangement means getting your creditors and debenture holders and banks and all the third parties to come to an arrangement, to come to a settlement to reduce their claim. Okay, to reduce our liability, our company's liability, and settle for less. We will say the creditors, debenture holders to settle for less, to sacrifice their amount. Okay, that is what is meant by compromise or arrangement. Because company is about to die, right? So we have to present to them that the company will die. If the company liquidates, if the company winds up, then the chances of you getting your full amount is very less. So please sacrifice some of your amount so that the company can be saved, and in the future you will benefit from our company. Okay, that is what is meant by compromise or arrangement, and the creditors will negotiate with the company to reduce the claim. All right, then we have surrender of shares. Now surrender of shares means we will talk with equity shareholders, we will negotiate with equity shareholders to surrender some of their shares, to sacrifice their shares and give it back to the company. So those shares can be given back to the given to the creditors or debenture holders for sacrificing their claim. Okay, so it can be given to creditors and debenture holders, and unissued shares can be cancelled. Okay, that is what is meant by surrender of shares. Now here the most important things is reduction in share capital, compromise, and variation of shareholders' rights. Okay, these three things are very, very important. All right, these were the different types of methods of internal reconstruction. Now let's see the journal entries of internal reconstruction. Okay, the accounting treatment, I mean. All right, now let's see the accounting treatment that is required under internal reconstruction chapter. All right, see, in this chapter accounting treatment is very, very simple. Okay, you just have to pass some journal entries. Okay, some journal entries you have to pass, and then you need to prepare a balance sheet. Okay, that's all. Some journal entries and a balance sheet. See, if you're getting a short marks problem like 5 marks, 6 marks depending upon your university, then you only have to pass the journal entries. If you are getting long marks problem, then you will also have to prepare the balance sheet. The question will ask for that. Okay, so journal entries and balance sheet, that's all. And the journal entries are also very simple. All right, and one more account will be opened over here, a temporary account which is called as a capital reduction account. Okay, capital reduction account, this is very important. This account is very important, capital reduction account, because everything revolves around it. See, to carry out the scheme of internal reconstruction, we will use this account. Okay, capital reduction account. See, what we have to do in internal reconstruction, we have to revalue the assets. So to revalue the asset, we will use this account, and then we have to reassess the liabilities, right? We have to decrease the liabilities. So to decrease the liabilities, we will use this account, capital reduction account. okay? And then we have to write off the accumulated losses, and then we have to eliminate the fictitious assets. So to do all that, we will use this capital reduction account. All right, and this account is also known as by the different name called as reconstruction account, okay? Reconstruction account, but it doesn't matter, okay? The methodology, everything is same. The names may differ, but everything else is same. All right, so this is the accounting treatment that you need to do under internal reconstruction account. All right, okay, now let's see the journal entries. Now, before going to the journal entries, let me just recall this rule of debit and credit, that whenever assets increases, we debit them. Whenever assets decreases, we credit them. All right. And this is very important here, and it's exactly opposite with liabilities. Whenever liabilities increases, you have to credit them, and whenever liabilities decreases, you have to debit them. Okay, it's exactly opposite to each other, and this is very, very important over here, because here most of the assets will get decreased, so you would have to credit them, and most of the liabilities will also get reduced, so you would have to debit them. Okay, all right, now let's see the journal entries. Now here are the journal entries of internal reconstruction. The first journal entry is when face value of shares is reduced. What would be the journal entry when face value of shares is reduced? That means reduction of capital, right? See, here is the example. See, here the face value reduced from 10 rupees to 8 rupees, right? From 10 rupees to 8 rupees. That means the shareholders lost 2 rupees, and that 2 rupees is a loss to shareholders and a gain to us, right? We are getting a gain here. So we reduce the share capital from 1 lakh to 80,000, all right? And we reduce only face value here. Whenever face value is decreased, whenever face value is reduced, always remember you have to scrap off. You have to throw out the old share. All right, now how to throw out the old share? Theoretically, in the accounting sense, how to throw out, how to remove the old shares? Shares are liability, right? So to remove the liability, what would you have to do? To remove the liability, to decrease the liability, what you have to do? To decrease the liability, you have to debit it, right? That's what we will do. We will debit it. Share capital account, debit. Share capital account, debit. And here you will write old face value, that is 10. So 10 face value in the bracket you will write. It's better to write share capital account, debit. 1 lakh, entire amount you will write. Entire will be scrapped off. And then new is created, 8 rupees face value share. Okay, so see, to new face value share capital account, here you will write 80,000. Now why I have credited this? Because new liability is created. Whenever liability is created, liability is increasing. So whenever liability increases, we credit it. All right, and then we got gain of 2 rupees, right? Shareholder lost 2 rupees, but we gained 2 rupees. So that gain will go to capital reduction account. All right, it will go to capital reduction account. I told you, right? Capital reduction account will be open, a temporary account. See now the uses of capital reduction account as we progress. Okay, you got this idea, right? Okay, now let's see the next entry. See the next entry, when only paid up value is reduced. When only paid up value is reduced. I tell you, whenever there is a decrease in the, whenever there is a reduction in the face value, you have to scrap off the old share. But whenever there is a decrease in only paid up value, then you don't need to scrap off any shares. Okay, you don't need to scrap off any shares. You just have to reduce the share capital. See how to reduce the share capital. See, the face value is not changed, right? When only paid up value is changed, no face value is changed. Face value remains the same, 10 rupees, 10 rupees. So share, you don't have to scrap off any share. Okay, see, share capital account debit. Okay, you just have to reduce it. Share capital account debit to capital reduction account. You only have to pass the entry of only the reduction amount. See here, before it was 1 lakh, then it went to 80,000. So only 20,000 has been reduced, right? So that 20,000 will come over here. Share capital account debit 20,000 to capital reduction. It is a gain for us, right? Here the shareholder lost 2 rupees, right? So that 2 rupees will come over here. That is 20,000 over here. 20,000, 20,000, because 2 into 10,000, right? So 20,000. So share capital account debit 20,000, 20,000. Here the liability is getting decreased, so I debited the share capital account. Okay, now let's see the next entry. See the next entry, when balance of any reserve is transferred. Listen, okay, whenever you get a question and when you see reserves in problem, whether the question says or not, whenever you see reserves, then you have to transfer all the balances from the reserve to capital reduction account. Okay, you have to wipe out all the reserves. So if there is any reserve, you have to remove those reserves. So how to remove the reserves? Of course, the reserves are liability. It comes on the liability side of the balance sheet. So you have to debit the reserves to decrease it. Okay, because reserves are liability, to decrease the liability you have to debit it. Reserves account debit, whatever amount is there in balance sheet, you have to take it to capital reduction account. It is gain for the company now, so that will be credited to capital reduction account. All right, reserve account debit to capital reduction account. Whatever amount is given, you have to take that. So every reserve, okay, whether the question says or not, you have to remove the reserves and transfer the balance to capital reduction account. Okay, now let's see the next entry. Sacrifice by debenture holders and creditors. I told you what we do in internal reconstruction. We negotiate with debenture holders and we negotiate with creditors and all the third party liabilities. Okay, and we negotiate with them to reduce their claim, to sacrifice their money, to sacrifice their amount. So when they do sacrifice their amount to save the company, what happens is our liability gets decreased, right? These are our liability, creditors is our liability, debenture holders are our liability. So all these liability, when they get decreased, you debit them. Simple, right? Whenever liability decreases, you debit them. See, debenture account debit, creditors account debit to capital reduction account, right? Whenever they decrease our liability, their claim, then we gain. So that gain will go to capital reduction account. Simple, all gains will go to capital reduction account. Okay, so let's say 10,000 they reduce, so 10,000 here it will be 20,000. Okay, simple, right? Now let's see next. See, this is just the simple entries. Decrease in the value of liability. If there is any liability that decreases, you just debit it to capital reduction account. Okay, liability account debit to capital reduction account whenever there is decrease in liability, and whenever there is increase in the liability, exactly opposite entry, capital reduction account debit to liability. Okay, now, and this is exactly opposite to assets also. I told you, right? Whenever there is increase in the value of assets, you debit the asset account to capital reduction. Whenever there is a decrease in the value of assets, you credit the asset. Okay, capital reduction account to asset account. Okay, so increase in asset debit, decrease in asset credit. All right. Okay, so here there is one more entry: various accumulated losses, fictitious assets and loss on assets written off. Now I have one entry over here. It's a big entry, but I have clubbed them together. Okay, it's a club entry, it's a combined entry. Now you don't have to do combined entry if you don't want to do. If you know how to do it, then it's well and good, but if you don't know, you can do single entry, no problem, but it will save you time. See the entry: capital reduction account debit. Now here the capital reduction account was credited, right, everywhere. So the capital reduction account was increasing, the amount in it was increasing. Now that amount will be utilized, that capital reduction amount will be utilized to write off the accumulated losses, to wipe out fictitious assets and to wipe out loss on assets. Okay, so here the P&L account: discount on issue of shares, preliminary expenses, goodwill, patents, trademarks, all these things, right? These first three lines, all of this you have to write off. If the question says or not, you have to. P&L account debit balance, okay, not credit balance. There will not be credit balance, because credit balance means profit, but profit and loss, debit balance means loss. So you have to write off all these losses. So these three lines you have to remove them. Okay, you can do single entry, okay, and you don't need to do these slashes. No, you have to take line by line. I didn't have space, so I did like that. You have to eliminate these three lines. Okay, these three lines things you have to eliminate, whether the question says or not. Okay, these all are assets. This comes on the asset side of the balance sheet, so you have to credit them to reduce it, right, to eliminate them. And then if the question says, if there are some assets, overvalued assets, if there are machinery which is valued at 2 lakh but it is actually 1 lakh, then you have to reduce those assets. To reduce the assets, to decrease the assets, what you do, you simply credit them, right? And if it needs to be decreased by 1 lakh, then you need to credit the asset by 1 lakh. Simple. And if there are any reconstruction expenses, then first you have to pay for those expenses. Reconstruction account debit to bank account. All right, debit all the expenses, right? So reconstruction expenses to bank, the money will go out, right, to bank account. After that, this entry will be passed, capital reduction account to reconstruction expenses account. And then after writing of the losses and everything, if there is any balance left in capital reduction account, then we will transfer it to capital reserves account if any balance is left. Okay, now don't worry, we will solve a problem in the next video and you will understand this very clearly. Okay, don't worry, this looks very strange to you, this entries, but these are very simple. I tell you, really, these are very simple. You can do single entries here. It's not mandatory, it's not compulsory to make this club entries. Okay, this is very easy, very easy. All right, these are the journal entries that you have to pass in the internal reconstruction. All right, okay, now we will solve a problem in the next video, so please don't forget to watch that video.